Welcome back, investors, to Ticker Time News. I'm Adam, and GameStop is making some news here in the after hours. After the closing bell, they announced a 4-for-1 stock split, and the stock is up 7.3% in the after hours. It closed at $117.43. It is now up to $126 even. That's 7.3% is up in the after hours on this news of a 4-for-1 stock split. So what are the details for this stock split? Well, shareholders of record at the close of July 18th. So if you hold shares of GameStop at the closing bell on July 18th, then you will receive a special dividend of 3 additional shares for each share you hold. That is the 4-for-1 stock split. So if you have 1 share, then that will turn into 4 total shares. Now, the stock dividend will be distributed, paid out basically, after the close of trading on July 21st. Then trading will begin at the stock split adjusted basis on July the 22nd. All right. So the 18th at the close, if you have 1 share of GameStop, then at market open on July 22nd, you will then have 4 total shares. That's it. It's that simple. So if you want additional shares of GameStop, then make sure that you pile in like what's happening here in the after hours, up 7.3%. And you can get yourself some additional shares. Now, fundamentally, this does not change the company, not one bit. The company stays the exact same. It's just that now there will be more shares on the market. So, do stock splits cause the price of a stock to go up or down? Well, they can, based on emotion, right? And based on momentum. But that's it. The company itself, nothing has changed there. So to me, it's a wash, right? It doesn't mean anything. The stock shouldn't really go up. It shouldn't go down. It should basically stay the same on this news. But a lot of people like to pile in early as soon as this news comes out. And then once momentum gets going, then they'll sell out. It happens to Tesla. It happens to any company that has typically a lot of volume, a lot of attention. This can happen too. So that's what we're seeing now, and that's why the stock is up 7.3% here in the after hours, because of a 4-for-1 stock split. Now, on to the markets. I hope you had a good day in the markets. It was a mixed day, mostly green, except for small caps. They didn't really manage to get back over into the plus side, but every other major indice did. Bitcoin stayed green, Ethereum stayed green, and actually, if you want to lump cryptocurrencies into, let's call it one of the major indices to track, it did the best today because Ethereum was up 4.1%. The S&P 500 up 0.4%. The Dow Jones up 0.2%. The NASDAQ up 0.6%. The Russell 2000 down 0.8%. So there you have it. Now, let's go back to the S&P 500. Ticker symbol SPX is what I use to look at that. And remember, you can do this at home too. All the charting. There's a link in the description of this video for TradingView. Click on it, sign up, free account, doesn't cost a penny, and you can chart too. Okay, the stock market today, it exhibited a bit of volatility, right? Or choppiness, as we like to say, in the face of general growth concerns. And boy, oh boy, those growth concerns are going to become more evident when earnings start. I believe it is next week or the week after. We're getting real close now. Financial big banks, those are first to report their earnings. We'll see how they do and what they say. But a lot of what's going to drive the market when earnings season is here is, what do companies expect for the next quarter, for the following quarter, year end? Those will be the big topics driving this market. Okay, the major indices today, they did trade lower this morning. I'm going to open up that 15-minute chart so we can see this price action for today, because it was pretty wild, right? I'm going to open this up. It's lagging a little bit. I think we've got too many devices attached to the internet here, so it is lagging some. There we go. On your screen, front and center on the chart, this is the 15-minute time frame. So you can see this morning we sold off, and then we rallied, and then this afternoon we really tried to get a rally going, but it ended up failing right at 38.70. Okay, that was the high for today, I believe. Yep, 38.70 was the high for the day on the S&P 500. That's interesting, right? Now, as I mentioned before, they did close, the major indices closed with modest gains, up a fraction of percents, right? And we have this late rally here. The S&P 500 getting to 38.70, or for the SPY, I think that's around 387. Now, looking here at the 15-minute time frame, let me do something here. I want to show you the past few sessions. And I want you to tell me, let's go right here. We have 1, 2, 3, 4 sessions, the past 4 sessions for the S&P 500. Do you see a pattern, an overall pattern? I think I see one. Open low, go lower, and then close higher. I think that's what we see here. The past, 3 sessions in a row, that's exactly what happened. Today, we were able to at least open not as sold off as the past 3 sessions before us today. So that is some good news, right? Now, on the daily time frame, let's look at this real quick. I want to show you this. Volume today was light. It was below average. So I'm going to take volume off like I normally do here so we can open up and look at these daily candles. And look at that last candle on there for today. The wick on the top, on the bottom, practically even, almost equal, right? Now, on the daily time frame, the S&P 500 closed right on its 21-day moving average. The 21-day moving average is 38.43, and we closed at 38.45. Right there on it. There is nothing right now. There is nothing that can stop the S&P 500 from going up except for that moving average. And I mean going up to 3,900, right? Up to 3,900, which on the chart, let's go ahead and do it. 3,900 is right about here, okay? There's a blue line there marking it. It is just about the top of these 3 candles and a little bit under this candle over here. We will find some resistance at around 3,900 on the S&P 500 as long as we can break this moving average. Because if you go, let me take those marks off here. If you look back at the last time we got above 3,900, what stopped us from going higher? It was that 21-day moving average. Now, back here, way back here above my head, we broke through that 21-day moving average, no problem. And then, of course, when we were coming down, we fell through it with no problem. So it can be sticky. Moving averages are like that. They can act like gravity and pull you towards them. That is possible, right? So that's one thing to watch for the S&P 500. Can we continue to move above that? If we can, it's 3,900, maybe to 3,910. That's going to be the next area or our next zone of resistance. If we could break that zone, then it is really possible to get to 4,000 and fill this gap right here. That would be possible, right? And if we broke it up to 4,000, we would slightly break above this resistance line here on this wedge pattern, right? But that will be some tough resistance to break because we haven't been able to break since it started way back in March. So that would be really tough at 4,000 for the S&P 500 to break through that. It's more likely price action is going to continue to fade and become more tight, right? So price action at the beginning of this wedge, I mean, we had some extended days, right, of just boom, falling. Let's get that highlighter again. Just falling from the top to the bottom of the wedge, right? From the bottom to the top of the wedge. Do it again from the top to the bottom of the wedge. We broke through it and then came back up. Couldn't quite make it. Can we get to the top of this wedge now? And then find our way back down and really get price to start tightening up here for the S&P 500. That is a real good probability that that's what is going to happen. So 3,900, no problem to get there if we get past the 21-day moving average. And on the SPY, that would be 390, right? I think that would be an area of resistance. And if we could break that, we'd probably go to 4,000. And then we'd get stopped out right there real quick, real quick. All right, so back to the 15 again. And looking at today, I mean, the early morning session here, I'll just leave it like that. The early morning session, and I'll put volume back up so you can see clearly the beginning and the end. It was marked by a lack of buyers. There was no conviction from buyers or sellers, really. Declining issues, they led advancing issues by an 11-5 margin at the New York Stock Exchange and an 8-5 margin at the NASDAQ. But buyers did step in a little bit more towards the close. And you can see right here, these two candles, we really tried to work out a rally there. But again, it got stopped right here at 38.70. Okay, we got that. Now, this narrowing of the spread this afternoon occurred. And that's because we were rallying, or at least trying to. Decliners to advancers, right? The margin was 8-5 at the New York Stock Exchange and 6-5 margin at the NASDAQ at the end of the day. So a big difference there. More volume towards the end of the day. And you can see down here on the 15-minute time frame, we had more volume for about 30 minutes here that broke above the average. Typically, that doesn't happen throughout the day. Usually that's reserved for, the beginning of the day and the end of the day. So seeing that volume in the middle of the day or towards the end right there, that was impressive. And that's what you want to see, right? For a rally to be sustained, okay? You want to see volume come in hot and heavy. This today, it counts as a potential follow-through day. It didn't follow through very far. It was very choppy, so don't get me wrong, but at least it did end in the green. And remember, the past 3 sessions before today, that was a very difficult and challenging thing to do because we would drop hard and fast every single morning. Today, we didn't drop as hard or as fast. So I see that as a bonus, as a positive sign that maybe some momentum is building here, at least on the S&P 500, where maybe we could get price action to push this thing higher. and then finally get up to some real resistance up here at 3,900, and then maybe make it to the top up here at 4,000, and then we can short it as it goes back down. But I'd really like to see some long positions play out here in the short term for the S&P 500. Now, mega cap stocks, they offered some support to the broader market. The Vanguard Mega Cap Growth ETF, ticker symbol MGK, it was up today, right? It closed up, let's see, 0.6%. That's great. Now let's hold this number in our mind, right? Mega cap growth up 0.6%. The S&P 500 gained 0.4%. So it did better than the broader market. Well, let's broaden that out even more. 0.6% gain for mega caps. Let's look at the Invesco S&P 500 equal weight ETF, ticker symbol RSP. When I checked, it was flat. It didn't move. So that's the proof right there that mega caps were the driver for today like they were yesterday. So that's something that is key to watch. What are the mega cap stocks doing? Are they moving up, down? What are they doing? That will help you in determining what the overall or broader market is doing, right? Good. All right. Now, the top performing S&P 500 sectors, let's pull that up here on the right. And remember, you can get these if you would like. I can share them in the chat if you need them. But this is all of them. Let's open this up here. Get them all. And yep, look at that. Most of them are green. So the top performing ones that we have here are utilities. They were up 1%. Technology, a lot of mega caps in there. Growth stocks. That was up 0.9%. Healthcare was up 0.7%. Materials and industrials both up 0.6%. Only three closed in negative territory. They were consumer discretionary down 0.2, financials down 0.3, and energy, the worst performing, down 1.7%. And energy has been falling behind for a few weeks now. Just look at it. Let's pull energy up here on the chart, and you can see that it has had a rough go at it here over the past several weeks. Now, let me get rid of this highlighter down here at the bottom. This was highlighting the 200-day moving average. And what was energy going to do? Look at this. I think we have a clue to what may happen here with energy. And it has everything to do with this candle that was made today. Okay? So I want you to focus on the candle. This is what it looks like. I'll kind of draw it out up here. Maybe I shouldn't use the highlighter. Let's get something a little more delicate. All right. Here is our wick for the candle. Okay. That's it. Now the candle itself is like this. And let's see. Let's say about like right here. Okay. And then we can fill that in. Boom. And boom. And then we just go try to color it in the best that I can. Not working too well, but you got the idea, right? That's the type of candle that was made today. Little tiny wick at the top. Most of the candle is halfway or higher on the wick itself, and then it has a big wick at the bottom. You could call this a hammer candle. You could also call this a reversal candle. Now, a reversal candle, what does that mean? Well, when it's coming from being down like today, you could say that price for energy got down really low, like all the way to the bottom low, right? And then price bounced right back up. I'm doing horrible at drawing. That's a horrible arrow. But price moved right back up, and it left this long wick underneath it. That is typically a reversal. Now, we can do the same thing and draw another wick and put the candle down here at the bottom. Again, a horrible job at drawing that candle there. And just trying to fill that in a little bit. But the wick is at the top of the candle, not at the bottom. That's a reversal also. So I'll be interested to see what happens tomorrow to energy. Is it going to continue this multi-week slide that it's on, or is this truly a reversal that just dipped right below its 200-day moving average here and pulled right back up into this green box, this kind of support area that it's been in before? It's an interesting thought here, isn't it? Let's go back here just a little bit, and I'm going to show you this candle right here. I should make this a different color to make it easier to see, and that's what I'll do here. Let's make it stand out a little bit more. All right, this candle that's right here. I know it's hard to see with all these other candles here, but it's right down here. It's a candle that's got a big wick on the bottom. The candle itself is at the top. That's a reversal candle. And then what happened here? Well, we were selling off, right? We had a reversal candle, and then what happened the next day? Well, we started to rally. Okay, let's see if we can find another one. Here's one in the opposite direction. This candle right here. It's a green candle, but the wick of it is really hard to see, but the wick is at the top. The candle itself is squished up all at the bottom. So what happened? We were rallying. We got a reversal candle. The next day, what did we do? We started to sell off. So there's a few ideas there of what a reversal candle looks like and, what it can do. And it can be a good sign that says, hey, the market seems to believe that we're going to reverse now and start moving in the opposite direction. So that's interesting because it did get down to its 200-day moving average today. It dipped below it, but it pulled itself right back up into this support area that's been in before. So I do find that interesting. Now, it doesn't work every time as a reversal. As a matter of fact, if we go look right here, there is a candle that has a big wick at the top, and the candle itself is all squished up towards the bottom. It didn't signify a reversal, but it did cause a few days of trading sideways. So it doesn't always work. So I'm not saying that, hey, energy is going to reverse tomorrow, but it could. It could. And this is one sign that sticks out in my mind that says, hey, we need to watch out. Energy could reverse tomorrow. Because, energy is oversold. RSI, 33.27. technically it's 3.2 basis points above being oversold, but it's pretty darn close. And the RSI has been low since June 17th. It dipped out of its comfort area at that point. Money flow also really low. It's down to a 27.7. Over this next weekend, I'm going to update a few of my indicators. I'm going to get some new fresh indicators on the charts. I'm going to learn how they work and how to use them, because it'll give us a much better guide to reading this stuff. And I just have to get it set up here on TradingView. But it'll be fun. So that's something interesting that's coming up really soon on the channel for all of our charting that we're doing. All right, let's look at oil here. First, let me go over to the comment. Sorry, David, I didn't see that one. In your experience, does the size of gaps affect the time frame or chances of it getting filled? No, it does not. If we look at the S&P 500, remember we had some pretty big gaps. Let me take the volume off so we can get this as clear as possible so we can see it. Just the most recent gaps that were made here. If we look, obviously we had this big gap that was filled, not filled. It's left unfilled right now. We also had this big gap right here, which got filled. Let's see, 1, 2, 3, 4, 5, 6, 7, 8 days later, it got filled, but the one above it has yet to be filled yet. So all gaps must get filled. That's the old adage, right? Sometimes you can have a company like Tesla, a stock like Tesla, and it can just shoot up, right? And it can leave gaps all over the place. And then it could take months, maybe a year, for some of the gaps that it left behind to get filled back in. So in my experience, time does not really play a role in when or how the gaps get filled. It's just an old adage that all gaps get filled at some point, right? It would be cool if there was a calculation that you could do that says, if you have a 1% gap, then in 7 days, that 1% gap gets filled. That would be some pretty darn cool technical analysis if we had that type of information. But we don't, unfortunately. Oh, one other thing that I'm adding this weekend to all of the charts is I'm going to start adding the weekly expected move. So we know exactly where the S&P 500, where the SPY, the Qs, the NASDAQ, where they're expected to go on the chart during that week, okay? So I'm going to add those to the chart. I'm going to clean up the charts a little bit too, take some of these blue lines off and just have the expected moves on the chart, because that'll help us all out greatly with identifying, are we getting extended? Have we reached that weekly expected range yet? And the weekly expected range is accurate 98% of the time. So that's pretty cool. And you use option market data to fill in those expected moves, where the numbers are coming from, I should say, right? So that's coming also starting on Monday. I'm going to add them over the weekend, so we'll have them. Now, it only works on stocks that have high volumes, right? So if it's a smaller cap company that doesn't have a lot of volume to it, then it's going to be harder to identify where those weekly expected moves should be made, okay? So that's coming this weekend. I think you guys will like it. I like it. I've been using it now, and it's really easy, and it will make it a whole lot easier to kind of convey this message and show you guys exactly how to do it and where those expected moves should show up on the chart. And we'll also be able to track how those expected moves have been working out, right? Week by week. All right, let's keep moving on. Neat idea for next week. Thank you. I greatly appreciate that. Yeah, I saw some old gaps on the from 2020, I believe. Okay, let me pull it up. Let me pull it up. All right, quick. You know, if we look here, there is a gap, a recent gap, right where the highlighter is sitting at. The Russell 2000, okay? That's what I'm looking at right now. The Russell 2000. There is a interesting thing happening here that occurred with the S&P 500. Could this maybe be saying that, hey, watch out for tomorrow, because the Russell 2000 got to its 21-day moving average, which was coming like this today. It tagged it, and then it pulled back off of it and ended up having a down day. But if we look at the 15-minute chart here just real quick, you can see that this morning it opened, it moved, it did good, right? It tried to have that rally in the afternoon, but no, it got cut off right at a very interesting level, right here at 1736. And got sold off from that point. All right, back to the daily view on it. So that 21-day moving average is a resistance area for sure. But this gap right here has not been completely filled in yet. And that's where this highlighter right here came from. It's also an area that could become resistance a bit, right about 1780 on the Russell 2000, 1780. That could be an area of resistance, but there is a gap that needs to be filled in all the way from, let's see, 7080 up to 1802. So that gap needs to get filled back in still. Hopefully it will get filled back in soon enough for us there. All right, let me go back and just look a little bit further. Let's see. There's 2020. You remember the month that you saw the gap in? We got 2019 highs right here at 1720. So it's real interesting. Let me I'm going to put a line on the chart at 1720 because that was about the 2019 high there. Maybe a tad under that. And you can see we touched that. We already broke that on June the 16th. That's so interesting that the SPY, the Russell 2000 itself has broken under, its 2019 highs. That's just something else. Okay. It could have been 2019. I wrote it down at home. Okay. No worries. If it's under this 1720 area, it might be tough of a fill-in because I don't know how much lower the Russell 2000 is going to go. If we look at it on a year-to-date, it's down 23% year-to-date. That's pretty far. That is definitely pretty far down. I think the next area here, and I do think we'll have at least one more low. It's probably somewhere between 1610, maybe 1615, down to about 1575. That's the zone I would look for another low for the Russell 2000. So about 1615, and then drop that down to 1575. That zone right there for the Russell 2000, that could be where the next low is made right there. But just something to keep an eye on. All right, WTI crude. That's where we were headed next with this one. US OIL. That's where we can go to and look at crude. Now, this is interesting to me too, because oil, obviously, it has broken down over the past couple of days. But if we look at this particular candle here, it came down to an area of support, right? Right about $95 a share. I'm sorry, not a share. $95 a barrel. And let me just get the highlighter out here to make it a little more easier to see what I'm talking about. So there's a support zone right there. It was tagged here. It was tagged through here. Big support right here from that big fall. And then before that, it acted as resistance. So that area at $95 per barrel is a very strong support area. That's why it came down, tagged that, and then bounced back up. Could this be a reversal candle? I'm not sure, because it does have a bit of a longer wick at the top of the candle, and the candle itself is a bit on the long side. You really want it to look like a hammer, literally, like a hammer. And that would be your best reversal. Like when we got to this top right here and this peaked, there was a really good reversal candle there to show us that, hey, you know what? We've reached the high. And there was actually two reversal candles, I would call them reversals, in a row here that said, all right, this is it. We're not going much higher. Boom. Take your profit and run from that one. And so, yeah. So, yeah, we've got this support line at $95 a barrel. The 200-day moving average it could come into play. That's sitting at 93.48 a barrel right now. But it is up a little bit, obviously, from its close. It's at 98.28 at this current moment. But, yeah, it did tag that 95.1 per barrel earlier this morning. So oil beaten down in the energy sector, obviously, but it is at a support zone right here. So it'd be interesting to see what happens tomorrow in this area. Again, because there is support here. Now, 2022 has proven to be a year where support zones, resistance zones, they can just get broke, right? Everything can just break down. It's been a great educational learning experience, study do-over of how support lines can fail, especially when you're in a bear market, right? Okay, so we got that there. Unleaded gasoline today, that thing also came down 3.1% to $3.24 a gallon. Natural gas futures went against the grain. It actually settled up 0.2% to $5.50 per British thermal unit. Now, we need to talk about gold. All right. It's a standalone. It's not in the sector, but we got to talk about it. Just GOLD. Pick your first one. That is fine on TradingView. But gold has collapsed over the past 2 sessions. It was down 1.5% again today to 17.38 an ounce. This isn't looking good for gold, but there's a very specific reason for why I think gold is performing badly. And it's because the US dollar is strong right now. As a matter of fact, if I overlay the US dollar, okay, and the ticker I'm going to use is DXY for the US dollar, okay, right there, press enter. Now, what we see here, it's not perfect, right? It's not a perfect correlation, but they do have some similarities, I'll say. If we go back to, let's just say, right here, I'm going to draw a line straight down. If we go from this line to the right, the S&P 500 went down. What did gold? What did the dollar? I'm sorry. Gold went down. The dollar went up, right? Okay, we got it. Now, gold went up. What did the dollar do? The dollar went down. Then the gold was kind of flat, right? What was the dollar doing? Kind of flat. Then we have a spike in the dollar, and we have a dip in gold. Following me? Then we have a dip in the dollar. We have a bounce in gold. Then we have this slow bleed out of gold, and we've got this choppy rise of the dollar. But then the past couple of sessions, that's really where it has blown me away. The dollar, the strength of the dollar has just gone straight up to the moon. And what has gold done? It's gone straight down, drilling into the center of the earth. See this correlation here? It's actually an inverse correlation, right? When the dollar is strong, gold is weak. So what can we learn from this? At least for the meantime, as long as the dollar is strong, gold will continue to be weak. When the dollar starts to pull back, that's when we could place a swing trade to go long on gold. At least that's what it looks like. And this line that I put in, this goes back to April of this year. So not very long, but from April of this year to today, that's how they have been an have an inverse correlation to one another. When the dollar is strong and the dollar is rising, then gold is falling. All right, I just want to point that out to y'all so you have that information and you can tuck it in the back of your mind and you can use that to either short gold or pick a spot to go long gold, right? Now, this is just fascinating that the dollar is having such an effect on gold. All right, let me remove the dollar there from gold, and we're going to move on to the treasury market because treasury yields they saw some whip action today. The 210 spread stayed inverted, all right? The 210 spread stayed inverted. Now, the 2-year, let's look at that. US 0 to Y. Press enter. The 2-year yield settled up 12 basis points to 2.94% after hitting 2.76% before the open. And it's up a little bit higher right now to 2.99. You could probably round that up and say 3%. But it bounced off of our sideways moving zone here where the highlighter was, and now it's rising back up above that. Okay, let's look at the 10-year, right? The 10-year was up 10 basis points. US 10Y, and we've got the 10-year, excuse me. The 10-year basically, paired perfectly with yesterday, doing the opposite. But it settled at 2.91. It's up a little bit to 2.93 at the moment, but it was down as low as 2.74% at the open, right? All right. So the inversion still holds, which isn't a good thing. That says a recession is coming, right? Let's look at the actual US dollar index. DXY is what I'm using here as the ticker symbol to look at the US dollar currency index. And on the right-hand side, it'll say TVC. That's the one that I'm using. And you can see the strength of the dollar. As a matter of fact, let's go out here just a little bit further and look at that. We could say this began June of 21. It rallied, but from February of 22, that's where the dollar really started to take off. Okay, it was up today another 0.5% to 107.06 is where it closed. It's down just a little bit from that, 107.04 right now. But when we look at this, I mean, my gosh, the dollar has been accelerating since June of 2021 and then took off with a steeper incline from April of 2022, this April. Now, whenever stocks go up, and this works for the dollar too, when something goes up too fast, it usually comes back down pretty hard. Okay, so just keep that in mind here with the strength of the dollar. I mean, you can see this major incline right here, and then we got a real hard pullback back down to a support area. And then boom, we went up real fast. We came down pretty hard. Where we are right now in that cycle is we are going straight up. Now, there's another correlation or inverse correlation that I want to show you here real quick with the dollar. And I am going to add the S&P 500 on top of this. Okay? All right. So, this does not always correlate, but there are some interesting inverse correlations recently, right? If we go back here to June of 21, when the dollar started to incline, well, if I highlight that same spot for the S&P 500, the S&P 500 was inclining also. If we go to where the dollar started to incline and go up at a steeper angle, well, that would be right here on the S&P 500. So let's zoom in a little bit closer on those 2 points, okay? So the dollar from this point right here, okay, the dollar goes up, the S&P 500 goes down. The dollar comes down, the S&P 500 comes up. The dollar goes up, well, the S&P 500 went up. So see, it's not perfect. But then when we get here, in this spot here, March of 2022, okay, the dollar goes up, the S&P 500 goes down, okay? Then we have the dollar coming down, the S&P 500 going up. The dollar moves sideways, the S&P 500 moves sideways, the dollar goes up, the S&P 500 goes down. The dollar comes down, the S&P 500 comes up. The dollar goes up, the S&P 500 goes down. Now, the past two sessions, as a matter of fact, let me back up the last two marks. Going from June 27th, 2022. So I'll put a line there and a line here, okay? The dollar went up in strength. The S&P 500 went down in strength. But the past two sessions, the S&P 500 has been going up slightly and the dollar has been going up nearly straight. So has this inverse correlation been broken over the past two sessions? Or is it a little bump in the road, you know, like it was right here? Oh, got the highlighter? Yeah, it's just lagging. Let's clean this up. Or is it just a small little break? Let's just clean this up right quick. Almost there. Or was it a small little break like it was during this rally that both had right here? And this would have been the snapback rally on the S&P 500. Remember, we had the death cross, and then the S&P 500 just boom, shot straight up over about a 7 or 8 day period, right? I call it the snapback rally because it was like a rubber band pulled back and then boom, you let go and that rubber band came snapping back. So this is interesting. Again, we find this inverse correlation to the dollar with gold and this inverse correlation with the S&P 500. I find it fascinating and interesting and something that I'm watching, right? Because maybe it could show trends. And that's really what I'm looking for, trends. I want to spot them. And I want to know when they change. Because when they change, then your investing strategy should also change for that matter. So there's the dollar. It is hot right now. And because it's hot, the euro continues to slip towards parity with the dollar. Okay? All right. Now, we just went over the correlation with the dollar being strong and how the S&P 500 is moving with that. And we could add anything, right? If you wanted to, I mean, we could look and see what are the Qs doing, right? How is tech reacting to this? So if I add the Qs on there, you know what? We're kind of seeing the same thing. An inverse relationship with the dollar, except right now. Right now, the Qs are going up, tech's going up, and the dollar is going up. So it may have been broken, but it is definitely interesting to watch for sure. Absolutely. Absolutely. I find it fascinating too. That's why I like to dig through charts and find interesting things that can give us an edge, right? Can give us something that can help. Okay. The biggest thing today that had the biggest weight to move the market, and this is why there was an attempted rally this afternoon. What came out at 2 o'clock Eastern time? The minutes from the June 14th and 15th FOMC meeting. And we were looking for clues, and quite frankly, there weren't that many. All in all, there was nothing surprising in the minutes, which conveyed the Fed's commitment to restore price stability and raise rates by another 75 basis points in July. Now, this is something to pencil out, write down if you haven't already. The July meeting, and this will move the markets, is coming up July 26th and 27th. All right? July 26th and 27th. Make sure you write that down. It's in your calendar. It is FOMC meeting day, okay? Where the Fed gets together and they vote on how high they're going to raise interest rates. They have said 75 is on the table. Prior to that, they said 50 is on the table. So, where are we going? We know commodity prices have come down, and that will play a role in CPI. However, it takes time for that to play out. It takes time for it to show up in the CPI report. Did the Fed get spooked into a 75 basis point rate hike and it was too much? Well, I mean, what do they feel? The minutes really didn't reveal what I wanted to know. And I really wanted to try to get a hold of what they're going to do in July and September. Knowing that information will tell us where the market's going to go. So we can speculate. All right, I wanted to quickly, I think any amount will still cause a sell-off. Thinking 25, a 25 basis point rate hike would be interesting indeed. However, if CPI, core CPI, if that comes in 8.8%, which last time was 8.6, if it comes in 8.8%, then I don't think there would be any disagreement in the Fed to do another 75. Because the Fed will see, oh my gosh, inflation. And remember, the CPI report is a lagging indicator. It's not what's happening currently today. So we'll see what the Fed does. The market will react. Obviously, if it's a lesser rate hike, 25, the market, it may be choppy. If they do another 75, I think the market will sell down. If they pause, the market will rally. So kind of three choices there. The probability of each choice definitely is different. I think economic data is really going to tell us about what the Fed could do. Okay, I wanted to talk about Amazon real quick because there's a little bit of history here, and I just want to talk about it for just a moment because I don't know if everyone here remembers or not about Amazon and what it did. Let's see here. I don't know. I feel like, actually, let me just put this up real quick. IDK, I know I feel like things haven't changed, but gas has come down a little bit. Yeah, a little bit. You're right. Things really haven't changed that much. Honestly, they haven't. The crops that were planted this spring, they didn't have enough fertilizer. They didn't have the right fertilizer to put on them. So the yield per plant is going to be less, meaning there will be less food, meaning food will cost more this fall when harvest occurs. So it's like a domino effect, and we haven't gotten to the end, or we haven't reached the end of that domino chain. And that's why I still have marked for the S&P 500 another low, maybe October timeframe. Timeframe I'm not so sure about, but I know there will be another low. I'm 100% sure about it. I could be wrong. I am not a prophet. I do not have a crystal ball, so roll with me on that one. But there's just so much going on. How could it not? I mean, have the midterm elections, has that drama even been brought into the markets yet? I don't think it has. I think we'll get through summer and then we'll be hit with that, and that'll just be another sinker for the market. So, all right. Let's dive in here to Amazon for just a moment. I just want to talk about this real quick. So Amazon, their chart is in front of you, but I'm not really going to talk about their chart. They were up 0.7% during regular session and up 0.1% in the after hours. They're at 114.50 at this moment per share. Head and shoulders pattern kind of broke there a little bit. Can it get up to the target range? I don't know, because that 50-day moving average is running into it. Okay, but what I wanted to talk about is Amazon is trying its hand again at food delivery. Again, right? Remember, it was about 5 years ago. Amazon tried and then later exited food delivery. And the reason they couldn't do it is because they could not gain enough restaurant supply to be competitive. So they cut it off. But now Amazon has entered into a partnership with the parent company of Grubhub, a move that instantly pushed shares of Uber and DoorDash down today. As a matter of fact, let's look at Uber real quick. UBER. Oh, gotta get the cursor right here. UBER. There we go. All right. Here we go. I just want to pull it up real quick just to see what they finished the day with for Uber and for DoorDash here. Let's see. It looks things are going a bit slow here on my end. There we go. All right. So Uber was down 4.5% during regular session, up 0.3% in the after hours. And DoorDash, it's DASH dash is their ticker. And they were down 7.4% during regular session and up 0.2% in the after hours. DoorDash seems to be trying to find a base here, I think. That's what it looks like. That's interesting. So DoorDash, they deliver food. Uber with Uber Eats, they deliver food, right? But as this deal with Amazon, as part of the deal, Amazon Prime members in the US, and unfortunately it's just the US right now, they can sign up for a free year, 1-year subscription to a rewards program called Grubhub Plus. Everyone's got that plus symbol right now, right? But with that, there is no food delivery fees on eligible orders. Currently, if you're not an Amazon Prime member, and before this deal, if you use Grubhub, there was Grubhub Plus that you had to pay $10 per month or $120 per year for the service. Now, a few more details on the back end of this deal that the public's not talking about. The parent company of Grubhub is Amsterdam-based Just Eat Takeaway. That's the name, Just Eat Takeaway. It acquired Grubhub 2 years ago for $7.3 billion. However, Just Eat Takeaway is actively exploring strategic alternatives for Grubhub, which could include a partial or full sale. To who? Maybe Amazon, because as part of the deal, Amazon has an option to acquire a 2% stake in Just Eat Takeaway, which it can increase to a total of 15% if certain performance factors are met. So, what's Amazon going to do here? Test the waters to see if food delivery can work again? It's definitely a cool perk for Amazon Prime members. If this becomes permanent, that $9 or $10 a month fee that Grubhub Plus charges, how's that going to factor into a Prime membership? Do you think a Prime membership will say the same price, but you can add on Grubhub, a yearly delivery of Grubhub for X amount of dollars? Or will Amazon try to, I don't know, absorb that delivery fee? It's an interesting question on what Amazon's long-term thinking is on this. I definitely can't wait to their next earnings call, which is still way over a month away, for someone to ask the question about what's the long-term vision here. It is interesting. Let's see here. I will use that for sure. You know what? I will too. I gotta say, I use DoorDash. Not a lot, but on occasion I use DoorDash. But I already pay for a Prime membership. So I'm sorry, DoorDash, but why would I pay extra for something that I can get for free? So I'll be using Grubhub too with the Amazon as an Amazon Prime perk. So what is that going to do then to DoorDash or even Uber Eats? Is DoorDash stock now going to be, there is a precedent for this, all right? Remember GoodRx. For the life of me, I cannot remember, was it GoodRx ticker symbol? Was it GDRX? Was that the ticker symbol? If not, I'll have to spell out the word. Yeah, GoodRx right here, GoodRx Holding. Remember with GoodRx, GoodRx is it's like a membership card. It doesn't cost a thing. It's like one of those free membership cards, but you can use it when you go to a pharmacy to get a better discount on prescriptions that you need. Well, Amazon went big on its Amazon pharmacy in a way, and I'm going to change this to a weekly view because I want to capture the fall here. So I got a lot of, I studied this one because there was a lot to study on investor psychology here. But if I open this up a little bit, you'll see the big fall. Let me just kind of clear this up. So anyways, Amazon announced that, hey, Amazon Pharmacy, we're going to start shipping, drugs down, making it prescriptions, that is, not drugs. And it's going to save a lot. So then what happened to GoodRx? Well, GoodRx sank real hard, real fast. And it's the spot I'm trying to clear up a little bit here and make it a little easier to see. But let me just highlight the area. Maybe that was it. So Amazon made the announcement, and then oh, internet must be getting tired right now. Anyways, this huge big candle right in the middle of the screen, just shortly after IPOing. This was a solid $50 stock, and it sank real far down to $30-something a share stock, right? Just because Amazon said, hey, wait a minute, we're going to do deliver medication to our patients or to our customers. And that hurt GoodRx bad, even though what GoodRx was doing was different than what Amazon was doing with its Amazon pharmacy, right? With GoodRx, you could go into a Walgreens or a Rite Aid or any type of pharmacy like that and use that discount card to get your prescriptions for a lesser amount. That's not what Amazon was doing with its pharmacy. I mean, they were trying to get, pharmaceutical, clients, right? Customers, but it was still slightly different. And it hurt GoodRx bad. Could this be DoorDash's future? That's what I'd be a little concerned about, especially if investors kind of misunderstand what's happening here. But quite frankly, with this is more of a direct competition to DoorDash, where GoodRx and Amazon Pharmacy, it wasn't a direct competition. So interesting thing to study and to understand and how investors perceive things, right? Okay, let's get on to a couple of the economic data points today. Prime already has a whole bunch of perks. You are correct. All right. First one up is the weekly MBA mortgage application index. It turned negative again, finally. It was down 5.4%. Remember, it was up fraction of a percent last week. To be expected. Interest rates went up, so these are now coming back down. We also got the June IHS Market Services PMI. The final reading was 52.7. The prior reading was 51.6. Remember, anything greater than 50 means expansion. Anything less than 50 means contraction. We also got the June ISM non-manufacturing index that came in at 55.3%. The expectation was 54.2, so better than expected. I guess the key takeaway that we could take from this report is that business activity for the non-manufacturing sector was better than expected, although growth slowed for the third straight month as businesses continue to grapple with pricing pressures, supply chains, and labor supply constraints. Speaking of labor, we also got the May JOLTS, and it dropped a little. Job openings stand at 11.254 million. 11.2 million jobs available. The prior reading was revised to 11.6 million. So it's gone down some. That's interesting because remember, if companies are taking jobs off the market because they're preparing for a recession, economic downturn, that's what they're going to do. So that is a key indicator right there. And since it has dropped, I don't think it's because jobs were filled. I think it's because jobs were taken off the market. All right, looking ahead to tomorrow. Us market participants will receive the weekly initial jobless claims. Expectation is 234,000. And then continuing claims, the prior reading was 1.32 million. Is that what it says? 1.32 million. Those come out at 8:30 in the morning. I don't expect anything major from those. I think they'll just come out. We'll get the numbers above, below. It'll be okay. But for us tomorrow with the S&P 500, the 21-day moving average is very important for where we're at right now. And the second area is 3,900. That's another area that is important for us to watch. If we can break those two, okay? If we can break the moving average, and if we can break 3,900, then we're on a race to fill the gap to 4,000. That's what I think is. That's what I think could happen, right? That could happen now. That could happen in 3 weeks from now, right? It could happen in August. I hope it wouldn't take that long because we're not that far away from it, right? I mean, up 1/3% today or 0.4%, 13 points. You know, if we did 13 points a day, you know, it would take a while for us to get over 100 points. But I think that's where we could be going for this seasonality summer type rally, right? That's what I'm kind of leaning towards. But then after that, I think it's back down, new low for us. Okay. Any other questions? Otherwise, I finished everything I wanted to cover today. If you could do me a favor while you're getting those questions ready, if you have any, click that like button, share this video with your friends, and come join investors just like you and me by clicking the first link in the description and join us. Tons of information to help you along your investor journey. All kinds of information. Top 10 list for certain, momentum stocks, growth stocks, dividend stocks, trade setups, all kinds of good information. So click that first link in the description. Come join us, be part of our investor community, and we'll just keep growing and doing our thing and trying to beat this crazy market. Okay, let's see here. You answered them all. Wonderful. All right, well, then we'll wrap it up here. Thank you, everyone, for being here with me today. I greatly appreciate each and every one of you. I'll be back here tomorrow after the market has closed to dive into what happened, why it happened, and what we can do to get ready for the next day. All right, thank you so much for joining me, and I will see you guys. Let's get this ready. All right. That's it. Good night. Have a wonderful one, and I'll see you in the next video.